I know there's a lot of you out there that are currently sitting on cash or thinking about delaying your next monthly investment. And there's no wonder why. The stock market has been on a non-stop downwards march for the last 3 months. In fact, this is one of the sharpest declines of the last 70 years. That will make anyone nervous. So you're hesitating. You're thinking, maybe I should just wait until the market bottoms out, or at least until it starts to recover. Then it will be a good time to get back in again. Well, if you can put your emotions to one side for a minute, does that actually make sense? Well, in this video, we're going to find out. Hello and welcome back to the channel. If you're new here, hi, my name is James. I'm a financial planner, and this is a place where you can learn to make smarter financial decisions. Let's get straight into it. I have absolutely no idea what the stock market is going to do over the next few months. None at all. Inflation could keep rising, the Fed could keep raising rates, and the markets could keep falling. Or inflation could start to show signs of declining and the markets could spring back up. I don't know what will happen. And if I did, I would be a very rich man. And I certainly wouldn't be here on YouTube talking about my strategies. So this is the first thing that you need to understand. No one knows what is going to happen in the short term. Sure, lots of people have opinions, but opinions are very cheap and they are rarely ever backed up by action. You know this. You've heard this over and over again. You cannot time the market. And yet, at times like this, no matter how educated or disciplined an investor you are, there is this primal part of you that is telling you this is wrong. Don't invest. Just wait. When the markets are rising, that same part of you is telling you, hell yeah, let's get stuck in. But when they're falling, no way. But you need to stop these thoughts before they turn into behavior, because they're not good for your mental health and they're certainly not good for your pocket. But if you want to have any chance of stopping these thoughts, you first need to understand why you feel like this in the first place. At the end of the day, we are just a big bunch of monkeys. We are big apes. And one of the main ways that we and other animals learn is through a process called positive reinforcement. If we perform an action that gets a positive result, we build a connection between that action and the result. It becomes learned, and we're then more likely to repeat that action. In an experiment, a pigeon presses a button and it gets some food, and it learns the connection between the action and the reward, and it goes on to do it again. One of our ancestors picks fruit from a tree they'd never seen before. It tastes good, so they do it again. And if that fruit ended up making them ill, well, they'd learn to avoid that tree. It's simple stuff, but this has kept us alive for millennia. And this type of learning happens fastest when the result happens directly after the action. Because if you do something and then it takes 3 months for you to see a positive outcome, it's much harder to build a connection between that outcome and the result. The perfect example of this is the endless internal battle that we face between eating junk food and healthy food. Junk food has a much stronger immediate reward because it tastes so damn good, but in the long term, it has negative effects. Whereas healthy food may not taste as good up front, but it has a long-term positive effect. The association with the short-term reward of junk food is much stronger than any knowledge of any long-term benefits of eating healthily, which is why we often find ourselves doing things that seem good for us in the short term. They feel good, they taste good, but they're actually really bad for us in the long term. So now let's extend this healthy versus junk food analogy into investing. When the markets are high and rising, we see a high chance of a reward in the short term. Whereas when the markets are low and falling, we see a high chance of short-term pain. Our monkey brains are designed to keep us alive in the short term. Because if they can't do that, there's not going to be a long term. So if we perceive that there's going to be a high chance of pain in the short term, but we might see a positive reward in 3 years' time, that seems like a terrible trade. 200 years ago, the human life expectancy was just 30 years old. 3 years in a 30-year lifetime is a hell of a long time to wait. So it's no wonder that we shy away from these types of actions that can be positive for us in the long term. Our brains are hardwired to prioritize short-term benefits over long-term gains. And this has kept us alive for millions of years. But it now makes us absolutely terrible investors. However, the good news is that just like with eating healthy foods, we can condition ourselves to want to do the things that are best for us in the long term. So that's what we're going to be doing in the rest of this video. You are the ape in my experiment, and I'm going to condition you to start behaving in a way that ignores short-term pain in favor of long-term gain. Starting with this. Here we have two funds, A and B, and we can see that over the last 2 years, A has returned 25%, whilst B has fallen by 2%. Now, if you were given a time machine and able to go back and choose which one of these funds to invest in every month, which one would you choose? Your monkey brain is saying A. Of course it is. Plus 25% versus minus 2%. But let's take a closer look. If you've been investing £100 a month over this 2-year period, you would have invested a total of £2,400. In Fund A, you would have ended up with £2,700 or £300 worth of growth. Whilst with Fund B, you would have ended up with £2,890 or £490 worth of growth. That's 60% more than with Fund A. This is why you want the stock market to crash. As a long-term investor that is dollar cost averaging into the market, this is good for you. Here's another example. This chart shows a simple dollar cost averaging strategy that invested $100 into the S&P 500 every month starting in 2007, just before one of the largest crashes of all time. And the chart shows us how much each monthly payment would have then gone on to grow to by the end of that period. And as we can see, the highest growth was achieved through the investments that were made during that crash. Investing at that time would have been incredibly hard. Your monkey brain would have been going absolutely nuts. But if you'd stopped, if you delayed those investments, it's likely that you would have missed out on some of the biggest gains available during that period. Yes, as we sit here with perfect hindsight, you might think that you might have been able to wait and time the market and get in at a better price, but there's just a bigger chance of you missing it altogether. So why put yourself through that stress for such a slim chance of making a small, higher gain? Stop being greedy. When you can follow this super simple strategy of investing every single month that will deliver you all the returns you need. Let's look at this another way. In the US, the stock market has fallen by 20% from its peak. How long do you think it might take to recover? 2 years? 3 years? Well, if it takes 3 years to get back to its peak, which is how long the markets took to recover after the 2008 financial crisis, you would have achieved an 8.33% annualized return on the way back up. If it takes 2 years to recover, that will be a 12.5% return per year. Even if it takes 5 years to recover, which is how long it took the markets to recover after the dot-com crash, that's still a 5% annualized return. So why are you turning your nose up at that? Yes, there's a chance that the markets may continue to fall, but why take the risk on losing out on this return? Lock in this price now, and if the markets do keep falling, well, that's great news for next month. And if the market does go down to 30%, then you'd get this on the way back up. Down by 40%, and you'd get this. Even over a 5-year recovery, that's still an annualized return of 13.3% per year. Just like with healthy eating, you need to condition yourself to view these actions as being positive. I know it feels unnatural, but you need to overcome your monkey brain and learn to embrace the pain. Now, if you like this video, you are going to love this one here, where we dive even deeper into behavioral finance so that you can learn to become a better investor. I'll see you there.